Hello, welcome to this lecture on leverage. Thanks for watching. Purpose of this lecture is to answer the question, how much debt should I take on in my commercial real estate investment? You've learned how much you can take on. Separate question, should you go all the way up to that max? To answer that question, we're going to look at the relationship between leverage, or the percentage of debt in my investment, and equity returns. And we're going to show that as we increase the amount of debt I have in my investment, if I increase my leverage, my overall risk in terms of my return outcomes increases. So more leverage, more risk. How does leverage work? Let's say you have $150,000. Now you have two choices. You want to invest that in commercial real estate, specifically retail property. You can buy, say, a single shop at $150,000, or you can buy a bigger shop, or maybe a collection of a couple shops for $400,000. Now you can buy the $150,000 investment in pure cash, so you will be unlevered and have no debt obligations. To buy the $400,000 investment, you need to find $250,000 of debt. And in this case, we're going to assume a lender offers that to you at 6% interest, interest only, over the course of that investment. So let's look at the implications in regards to the return from both investments. First point, when you have positive leverage, which is a term I'll define later, that will inflate equity returns. You'll get a higher return than you would have if you'd gone in unlevered. So investment A option was your unlevered, I buy the $150,000 shop outright. An 8% income return from that property. We're going to assume you get 8% from both properties. Gives you $12,000 a year from the smaller shop, but you have no debt obligations, so the total money in your pocket, the equity before tax cash flow is $12,000. The $400,000 property also earns 8%, which is $32,000 for that year. However, you have a debt obligation and a service payment to make. 6% of $250,000 is $15,000. You owe that to the lender. At the end, you have $17,000 in equity before tax cash flows. This is a situation of positive leverage because your income return is higher than your, I should say, positive leverage in regards to the income return, because your income return is higher than the cost of the debt. So therefore, with the same money, $150,000, you've now made $17,000 instead of the $12,000 you would have made had you gone in unleveraged. Now, leverage works both ways. When it is negative or unfavorable, your losses increase. But what if the tenant vacates? Now you have no income. If you if you bought the property unlevered, you have no debt obligation, so you make no money, but you don't lose any money either. In the levered situation, you have no income, but you have a $15,000 debt obligation. So you have to raise an additional $15,000 to pay off that debt obligation and avoid foreclosure. So therefore you have a loss of $15,000 because you have to invest another $15,000 just to stay in the investment. Income returns, we just covered. How about capital returns? Key point here, all capital returns, positive and negative, accrue to the equity investor. No effect on the debt investor. So let's say we sell that properties for 5% capital gains. Well, I will end up making $7,500 from my unlevered investment. So that's $150,000. That's 5% of $150,000. I will make $20,000 from my levered investment. So notice I sell a $400,000 asset for 5% gain, which is $420,000. I then subtract off my cost basis from equity, $150,000, my debt repayment at the end, $250,000, leaving me with this $20,000 capital gain. So that's the inflation of the property in both cases. So again, capital gain inflated or directly translated to the equity investor. Capital losses also directly transfer to the equity investor. Notice this case. Same thing, but now we're losing 5%. So I have a negative loss in property A, negative loss in property B, exactly equal to the change in capital value over time. Let's look at another example on Excel. Here we're going to have a $100,000 property. We're going to go 50-50 debt equity. We're going to look at the relationships between our equity returns and the debt returns, both leveraged and unleveraged. In two situations, one good one where we have positive leverage, one not so good one where we have negative leverage. So if we look at our 10% income return, this is positive leverage. Notice my $100,000 investment, if I went in unlevered, I would make $10,000 for a return of 10%. Again, we're looking just at income returns. I'm going to add some debt to it. I'm going to get $50,000 of debt. That debt is going to cost me 8% in this scenario. So 8% of $50,000, interest only, is $4,000. The debt investor makes an 8% return. Remember that unleveraged returns plus debt is our equity before tax cash flows. Therefore, with a $50,000 equity investment, a levered investment, I make $6,000 income return for a total income return of 12%. Again, positive leverage inflates equity returns. Flip the script. Now we have a 5% income return. This is negative or unfavorable leverage. Notice the debt return does not change. Still required a $4,000 payment on a $50,000 debt investment for an 8% return. Now, however, I only have $5,000 of income, so my equity return is $1,000 on a $50,000 investment, which is only a 2% return. So as leverage turns unfavorable, my equity returns are much lower than they would have been had I invested unlevered. Right? Had I invested unlevered in this situation, I would have been earning 5%. Levered, I'm earning 2%. Things can get even worse. If I have a 2% return, if I had invested unlevered, I would have a 2% return. With leverage, I now have a negative 4% return. I actually have to raise an additional $2,000 of equity in order to pay off my $4,000 debt. So the key thing, as I increase my leverage, meaning as I increase the percentage of debt used to fund and finance my real estate investment, I increase risk. I increase the variance in returns, both good and bad. So when things go well and I'm highly levered, my equity returns are much higher than they would have been unlevered. If things go poorly and I'm highly levered, my equity returns are my equity losses are much higher than they would have been had I been unlevered. And this example here that you can see on the slide shows that exact example of the $100,000 investment under the first two scenarios, the 10% return, which is positive leverage here, showing that the closer I am to being unlevered, I get a 10% return. As my leverage increases, that 10% return starts to grow. This is the equity return for income until it starts really increasing as I get closer and closer to full or 100% leverage. This only goes up to 90%. On the other hand, when I'm in negative leverage, the 5% return, what would have been a 5% return unlevered, starts declining until I turn to a loss at about 60% leverage. So if I've taken more, I'm now having to raise equity in order to avoid foreclosure. So notice that variance in returns, the sensitivity of my returns to changes in the market increase the more debt I take on. So I use the term positive, favorable leverage. There's also negative and unfavorable leverage. How do I know which one of those two I'm in? A lot of textbooks will tell you just simply compare the yield or the cap rate with the interest rate on the debt. That works for income returns. However, remember that there's two components to a real estate investment. You have your income returns and you have your capital returns. So your total returns are the sum of both. We've learned that unleveraged IRR is the overall property return, or the total property return without debt. So that is the benchmark that you should use. That's the overall property return. In terms of the debt return, you would use the effective interest rate, which includes all of the fees associated with entering into a debt arrangement. So the cost of debt is not necessarily just the interest rate. You will also be paying fees for the lender to be involved in your property investment. So the key to understanding whether you're in positive or negative leverage is comparing your unleveraged IRR here with your interest rate. If the unleveraged IRR, or the inherent return, total return in the property, is greater than the interest rate, you're in a positive leverage scenario. If it's the other way around, if the debt interest rate is, effective interest rate is higher than your unleveraged IRR, you're going to see negative leverage. So if you're in positive leverage, right, your equity returns inflate the more leverage you have. If you're negatively leveraged, it's the other way around. Your losses increase the more leverage you have. So all investments on a pro forma look great. So positive leverage always looks good. So the question is, how much are you willing to risk in terms of your potential exposure to big losses by taking on more leverage when things don't go as according to plan in the pro forma? So the question of how much should I borrow is subjective. It's a risk-return evaluation. You need to match your risk profile with your investment objective, but also your alternative investments. What other alternative investments with similar risk can I invest in to give me, and what returns do I get from those alternative investments? So it's common to use before-tax IRR, that measure of return, of equity return, to judge the potential outcome of leverage. So investors will look at before-tax internal rates of return with different scenarios. You have a good scenario, you have a not-so-good scenario, and you'd get a better picture of the potential risk in terms of the variance in returns that you take on as leverage increases. And as soon as you start to not feel so good about the additional risk you're taking on, it's probably a good idea to stop and not take on more leverage than that. The story of commercial real estate since the 2008-2009 global financial crisis has been one of caution with leverage. Most big institutional funds like REITs have dramatically decreased the amount they're levered, with ratios of 20-25% being fairly normal. So in class, we're going to discuss what we do when we're in a situation with negative leverage. So this slide presents a case study of a situation where the investor finds themselves in a negatively levered position, or you can even have it where the investor is about to invest in an investment where there's a situation of negative leverage, and we will discuss what to do. Do you go in all cash? Do you reduce the debt that you take on? Do you find a different property to invest in? Do you become a lender? Do you get out of the property investment business altogether, or do you have some other idea? So this is a fun case study to talk about how much leverage you should take on, and we'll discuss that later in class. Thanks for watching.